By now you can read trends, candles, structure, derivatives, and risk. Knowledge is the easy part. This is Chapter 1 of the Trader's Mindset module. The heading states the shape of it. The analysis was the short part, because patterns take weeks and a plan takes a weekend, while doing the same correct thing for years is the hard bit. The rule sits under it. On the left is time by task, measured to competence, showing where the difficulty actually sits. Learning the patterns takes weeks. Writing the plan takes a weekend. Following it once takes one trade. The scale completes. That is a single trade. Following it always takes years. The bar shows how long each part takes, and the analysis is the short part while repetition is the long one. On the right is what is left, because you already have the method. By now you can read trends, candles, structure, derivatives, and risk, and none of that is what stops most traders. 3 states describe it. Knowledge is learnable and learned. A plan is a weekend's work. Doing it every time is the actual skill, which is what this module is for. It is about the only part that cannot be read into place. A line closes the figure. Everything technical can be taught quickly, and consistency is the part that takes years. 2 traders with the exact same knowledge routinely get opposite results. The difference is not information. It is execution under pressure. So who is the opponent? Here is the answer as a verdict. The heading names it. 3 reactions, not the market, and that is the verdict to carry out of this chapter. The rule sits under it. On the left, the verdict itself. It reads, your biggest opponent is rarely the market. It is your own fear, greed, and impatience. And the 3 are drawn out. Fear exits winners early. Greed oversized at the top. And haste invents setups. On the right is why it holds. Name it, in the moment. Pre-commit, so it cannot act. And blaming the outside is the third option. Because blaming outside changes nothing. The 3 reactions are predictable, which is exactly what makes them manageable. A line closes the figure. The market is indifferent, and your fear, greed, and impatience are not. Markets do not pay the smartest analyst. They pay the trader who can follow their own entry, stop, and size rules, trade after trade, especially when it is uncomfortable, which is worth looking at more closely. The heading repeats it deliberately. Your opponent is rarely the market, because fear that exits early, greed that oversize, and impatience that invents setups do most of the damage. The rule sits under it. On the left are 2 opponents, and only one of them is real. Who you think you fight? The market, the news, manipulation, the algorithms, other traders. Who you actually fight? Fear that exits early, greed that oversize, impatience that invents setups. The recurring opponent is internal, because the market is indifferent to you and your reactions are not. On the right are those recurring 3, starting with the temptation to blame outside. Blaming the market is comfortable but useless, and the same 3 reactions cost most traders most of their money. Here they are again. Fear cuts winners early. Greed sizes up at the top. Impatience trades with no setup, which gives the line that turns the chapter. You cannot beat the market by beating the market, so you start with yourself. A line closes the figure. The market has no opinion about you, and every loss you can control starts internally. There is a 4th impulse worth naming too, the hope that makes you widen a stop. The market simply reflects all of those impulses back at you as losses. The cure starts with how you think about a single trade. The heading makes the counterintuitive claim. A losing majority can still be profitable, because 45 wins in 100 still pays when the winners are 2.5 times the losers. The rule sits under it. On the left are 100 trades, and the distribution they produce, showing one edge played out 100 times. The numbers sit together, 55 and 45, against 2.5 units and 1 unit. 45 wins, 55 losses, an average win of 2.5 units, and an average loss of 1. More losses than wins, and still profitable. The comparison underneath is the lesson. Any one trade is genuinely unknowable. 100 of them is statistically reliable. So you judge the sample. On the right is that thinking in samples, starting from the fact that no trade cannot lose. Amateurs look for certainty, while professionals accept that every setup is a probability and think in samples rather than single outcomes. 3 notes follow. The edge shows up over samples. Losses are part of the edge, and certainty does not exist here, which reframes every red trade. A losing trade is not a broken method. It is one draw from the distribution. A line closes the figure. Every setup is a probability, never a promise, so you judge the sample rather than the trade. A method that wins 45 to 55% of the time can still compound beautifully if the winners are larger than the losers. Once you truly believe your edge plays out over many trades, a single loss stops feeling like failure. It is just one sample in a long series, which changes what you score. The heading states the surprise. The rule-breaking win is the worst result because across 4 combinations of plan and outcome, the profitable violation is the most expensive one. The rule sits under it. On the left is plan against result, giving 4 outcomes, 2 of which matter. The columns are the plan, the result, and what it actually is. Plan followed with a win is a good trade, so repeat it. Plan followed with a loss comes next. The table completes it. That one is a cost of doing business. Plan broken with a loss is a mistake, and you paid for it. And plan broken with a win is the most expensive row of all, because the rule-breaking win pays you for the behavior that will eventually take the account. On the right is what to score, grade the decision. A random win from a rule-breaking trade is a bad trade that happened to pay, and it teaches a dangerous lesson. 3 notes follow. Plan followed is the only success metric. A loss with the plan is a cost of doing business, and a win without it reinforces the wrong habit, which gives the principle. Outcomes are noisy and decisions are not, so you score the part you control. A line closes the figure. A win that broke the rules is not a win. It is a lesson you will pay for later. A disciplined trade that hit its stop is a good trade with a losing outcome. Judge yourself on whether you followed your plan, not on the last result. Here is what that looks like on a chart. The heading makes the claim. No forecast appears anywhere in this trade, just an entry level, an invalidation, 2 held shakeouts, and a measured exit. The rule sits under it. On the left is the daily chart, showing the entry and stop against price. The chart fills in beneath. Then the markers appear, the entry, the stop, and volume with its 20-bar average. And the note underneath is the point. The trade was correct because the process was correct, and the profit is a side effect. On the right is the record, uncomfortable but clear. Nothing about this trade required a forecast, because the rules produced the entry, the stop, and the exit. The fields read across. The signal was a trend pullback. All of it was decided in advance. 2 shakeouts were held through, and the result was plus 2.6 units of risk. The process is repeatable, and this particular profit is not. A line closes the figure. The trade was right because the process was right, and the profit is a side effect. Every box was ticked. Price sat at a level that had held several times. The entry came on a bounce off it, and the stop sat just beneath where the idea would be proven wrong. A beginner reviewing a stopped-out version of this concludes the method failed. A professional concludes the method worked, because the job was never to win one trade. It was to take a defined risk bet with the odds in your favor, and to lose small when the odds did not play out. Run that same process across 200 trades, and the winners outweigh the small losses. Fixate on a single red outcome, and you will abandon the very edge that pays you. Outcome is one sample, and process is the whole distribution, which explains why this takes so long. The heading is honest about it. The last tenth takes most of the time, because knowledge accumulates fast and then flattens, while the difficulty of each remaining step rises. The rule sits under it. On the left is the shape of it over a career, plotting effort spent against difficulty remaining. The band split it in 2. Knowledge acquired against the difficulty of the step. The first 90% comes from reading and practice. The last 10% is behavior under stress, and it costs most of the total time. On the right is what to expect, being honest about the shape. The last tenth of the journey is behavioral, and it takes longer than the 90% that preceded it. 3 notes follow. Knowledge arrives quickly, behavior arrives slowly, and journals make it measurable, which explains the attrition. Expecting the last stretch to be fast is why most people quit inside it. A line closes the figure. The final stretch is behavioral rather than technical, which is exactly why it is slow. The technical knowledge is perhaps 90% of what you need to know, and maybe 10% of what determines whether you succeed. The mindset is the reverse. That is not a motivational flourish. It is why so many people can quote every candlestick pattern and still lose money. Charts are external and learnable in weeks, while temperament is internal and earned over years. The trader who wins is rarely the one with the most exotic setup. It is the one who can take the same boring, high-probability trade for the 1,000th time, size it correctly, honor the stop without flinching, and walk away when the day's plan is done. There is a frame that makes that easier. The heading draws the line. A business has books, and a bet has a story, so the frame is repeatable edges, rule-based size, quarterly judgment, and records that get reviewed. The rule sits under it. On the left is bet against business, in 4 contrasts, the same activity seen through 2 frames. The edge as a bet is a hunch, taken once, while as a business it is repeatable and measured. Size as a bet is how sure you feel. The table completes it. As a business, size is a rule, written in units of risk. Records as a bet are a story told afterwards, while as a business they are a journal that gets read. And judgment as a bet is on the last trade, while as a business it is on the quarter. That is what the rest of this module makes concrete. The principles, fear and greed, a readiness routine, and the daily habits behind all of it. On the right is the business frame itself. A business has fixed costs, known margins, records, and a review cycle, and so does a trading operation. 3 parallels follow. Costs, because losses are inventory. Margin, meaning expectancy per trade. And books, meaning the journal, which gives the closing thought. Nobody runs a business on how they feel about this afternoon. A line closes the figure. Treat it as a bet and the size follows your mood, and treat it as a business and the rules do. Losses are the cost of doing business, budgeted in advance rather than treated as disasters. Your capital is the inventory you protect first, because you cannot trade tomorrow if you blow up today. And steady, repeatable behavior beats occasional brilliance. One verdict closes the chapter. The heading states it, discipline over cleverness, and that is the verdict to carry out of this chapter. The rule sits under it. On the left, the verdict itself. It reads, markets reward consistency and discipline, not raw intelligence or clever predictions. And the two types are set against each other. The clever one predicts and adjusts mid-trade. The consistent one repeats and decides in advance. On the right is why it holds. Repetition beats brilliance. Rules survive bad days. And prediction is the third thing. Because prediction is not the job. The market pays for behavior, not for insight. A line closes the figure. Intelligence is not the constraint, and doing the same correct thing repeatedly is. There is a useful self-test after any trade. Ask whether you would take this exact trade again, the same way, 100 times. If yes, it was a good trade regardless of the result. If no, it was a bad trade even if it won. That one question keeps process in charge rather than the last outcome. That is the chapter. You just finished chapter 1 of the Trader's Mindset module. The analysis is the short part and repetition is the long one. Your recurring opponent is internal. Every setup is a probability rather than a promise. The rule-breaking win is the most expensive result of all, and the market pays for behavior rather than insight. This is education rather than financial advice. Thank you for watching Trendly Lab. Next up, the 10 principles that professional traders live by.